Right now, like the Midwest makes sense to buy now. It's not going through like a reset with floating rate debt or too much new supply. It's just growing kind of slow and steady. A lot of markets are at cap rates where you have positive leverage. It's just traditional real estate investing.
You're listening to Ice Cream with Investors, a podcast that is dedicated to teaching you how to better invest your money so that you can live a more intentional life. I'm your host, Matt Four, and it is my goal to teach and empower you to remove the roadblocks to your financial success.
All right, Drew, welcome to the show.
Hey, thanks for having me, Matt. Appreciate it.
Absolutely. Well, you know we like to start with the difficult questions here. What's your favorite ice cream?
Yeah, I know you asked that, so I was thinking about don't just say regular chocolate is too boring. So I guess my favorite ice cream is anything that has chocolate twice in it. So regular chocolate with some a chocolate in it, like Reese's peanut butter cups, or if it's like an ice cream bar or something, chocolate on the outside as well as on the inside. So double chocolate.
So, do you know what Culver's is?
I'm from Wisconsin, so it would be impossible not to.
Yeah. Well, we went to Culver's the other night with my fiance's dad, and he pulls up to the drive-thru and he's like, they say, "Can we take your order?" And they said, "What do you have that's chocolate?" And they listed like 5 things. He goes, "That'll do. Put it all in one." So
oh, nice.
You all would get along perfect, I feel like.
Yeah, they got a lot of good options at Culver's if you want to go wild. You can put like anything in, and also they don't call it ice cream there too. I thought that's what you were going to say. They would correct you. It's custard. So I thought they were, but yeah, nice. No, that's a spot to be for ice cream. So
either way, it's like drinking concrete. It's so thick.
Yeah.
Well,
Nice.
Tell our listeners, what's the scoop? What do you do today?
Yeah, I invest in multifamily buildings. I started out doing duplexes and 3 units, and today this is like 15, 20 years later, now I do deals that are larger to me, at least, somewhere between $5 and $35 million deal sizes now. I invest in Chicago, Phoenix, and then also I just recently moved to Texas, sort of getting going in Dallas and Austin as new markets. So,
gotcha. Well, take us back to your beginning. Where did your real estate journey begin?
Yeah, started early, where I started an internet business in high school, just selling items in video games. And before that, I had done other sort of like little side hustles. I started I was a magician. And then after the selling items in the games, I started a vending machine route. But really what I started in real estate, I was trying to figure out what to do with the money I made from the internet business. Between my about sophomore year of high school to freshman year of college, I made just right around $100,000, and
Whoa.
I didn't spend any of it. I saved it all, and so I just I literally all I spent was I bought a radar detector in response to getting a speeding ticket, and that was all. That's the only thing I spent the money on, and I just saved it all. And I thought this is so both my parents were teachers, and so my dad talked a lot about mutual funds and what he had invested in, and they were really big. They had a lot of really good money habits. They weren't in the business world, but they never, like if you asked them how to buy a car, they would say you just, whatever you have the money for, you just would write a check for, so I had like a lot of good habits from that, where most people, if you can afford the lease payment or whatever, then you can afford it, kind of talk, but you don't get as far ahead doing that. So I had these sort of really good lessons that they gave me. So when I started making this money, I just started doing what basically I already had heard about. And so I saved it. I invested in the stock market. I learned how to trade options. I bought mutual funds, and I lost money trading options. I didn't make any money in the stock market really. I didn't like how it was out of my control. And then too, also being a teenager, it was happening so slowly. I was like, I really like what I'm reading about in real estate. And I was reading a book, just breaking down real simply how it all worked. And I said, this makes sense. Like you have cash flow appreciation, you pay your loan down over time, you get tax breaks. It has a very low correlation with other types of investments. So when I go to college, so not, like I said, I'm from Wisconsin, and I went to college at UW-Madison. And so I said, when I go to Madison, I'm going to buy a property. And I did. So I bought a duplex my freshman year, which I moved into my sophomore year, and then was just kind of off and going since. Since then, I bought 4 properties in school, about $2 million total. Then I moved up to Minnesota to work after I graduated for an apartment developer there. Met met my first partner and investor while working there. It was an intern, and he's like, "Hey, I hear what you've been doing on your own. Let's go talk to my dad. Maybe he'd want to invest." Met with the dad, and they liked it and liked one of the deals that I brought to that meeting that I had printed out. And we ended up buying that deal, and over the course of the next 10 years, bought about $100 million of property. So feel free to interrupt me or whatever, Matt.
Yeah, I got a lot there to go off of. But first off, I've heard the story about that meeting. Where did you find the deal that you ended up buying?
Well, so I printed it off of LoopNet actually. So I brought deals to the meeting, but I didn't have them underwritten. They weren't like a full pitch book. It was more because I think what we did was we were out to dinner just like at Panera, me and the son, and we were. And going back to work, we worked the place you worked pretty hard where we were after dinner going back to the office, but we were, he had mentioned the thing about his dad. So we were like, let's go meet with him for lunch tomorrow, or the next day. So then I just printed out just like a wide variety of deals. I also had no idea how much money they wanted to invest. I printed out a duplex that was in, I think in the Uptown neighborhood in Minneapolis, and then a shopping center in that same neighborhood that was like $3 million, and then a condo deal, because this is in 2008, so at the end of September. So there was a busted up condo deal in San Francisco as an example, and just a wide variety of things. And they really liked the shopping center. I told them about what the cash flow would be. It was a 2-tenant retail deal in Minneapolis, and the location was really good. It was a brand new property. And he likes new properties because the dad owned a construction company, and it made sense at the time as a deal too, because the leases were signed kind of after the recession had started, because it's 2008, so things were, getting bad. But it was already signed at the low rents, and then it were 2 7-year leases, and so one of the tenants was Verizon Wireless, and then another one was was a tanning business, but like a large chain corporate lease. And so it's like you got to think by 2015 we're going to be like in a better place, and this deal makes a lot of sense today. Double-digit cash flow, like you get paid to wait. So that made sense. It was a simple pitch, and we bought it. So
yeah, I just think it's funny because you might be the first person in history that I know that bought a deal off of LoopNet.
Yeah, I know. Well, that's that's usually because the better deals aren't there. Yeah, that was. I mean, in 2008, CoStar wasn't as dominant. Even the place I had worked at, where they had 30,000 apartments, while I worked there, they signed up for CoStar for the first time. And so that back before CoStar bought LoopNet, I think that there were a lot more listings on it, and now it seems like those listings that were on LoopNet are now mostly on CoStar. So yeah, back in the early 2000s, LoopNet, that had a lot of deals on it. That was the spot. Could just be a timing thing too, because that website had its run. So
now it just seems like a good place to get your phone spammed.
Yeah.
If you sign up to look at a deal, all you do is get 10,000 calls in the next 24 hours.
Yeah, I don't doubt it. Yeah, mostly, all the stuff now that I buy, it's mostly through brokers, but not on the market. So I have actually not experienced that one yet, Matt, where I'm getting blown up on a LoopNet one. But I'll keep that in mind. Give them my Google Voice number then. It might be the best tip then. Got to get a Google Voice number.
You sound like somebody that's been involved in business since a very young age, and I'm always interested. Like, how did you get into business? Why was that like a hobby for you, building up this internet business?
I mean, I just always liked it. It was funny, because there was no one in my family doing it. My dad's dad, so my grandpa, he was a business guy. He was a car salesman, but not on the just one. He was like running a bunch of dealerships for AMC, like a car brand that's no longer in existence. But then he quit that and started a bunch of bars and restaurants and stuff in Wisconsin. But I never met him. He had already actually passed away before I was born. He had a heart attack. So I'm not, I don't know. They would just say that I was like him. So I don't really know. I just always liked it. And I just liked wheeling and dealing just naturally. When I was a kid, I would just, like my parents, I performed a concert for them at one point, probably when I was like 5, and I charged admission to it. And I would try to sell things to my sister. I have a sister who's 2.5 years younger than me, and I always try to sell her things. When Pogs were popular, or just any Beanie Babies, resell them to her. Just any. I just liked wheeling and dealing. And so I don't know where it came from. And it's funny, I have a son now, and I try to get him interested in that. Like where I told him if he makes a painting of, he's really been struggling writing his lowercase k's. Apparently that's the hardest letter to write. I told him I would buy that painting. And then he made a bunch of paintings to sell me. And so he, trying to pique the interest, got him to invest his tooth fairy money. So I don't know where it came from, but I'm trying to just stimulate that in my own kid, but not like force it on him. Like just say like, you got your $5 for the tooth fairy. Like, you could put that in one of the deals on our websites and turn it into more and just do what I'm doing. And he did. He actually picked a deal that we lived in for a couple years in Chicago. And so he threw his money into that, and he's up to like $12 now on that deal. So
how old is he?
Pretty good. He's 5.
Yeah. So I'm wondering, have you seen him respond to that kind of like influence? Because we have a 7-year-old, and he wanted to save up money to get a smartwatch, not like an Apple Watch, but a kid's smartwatch where you can block who calls and all that kind of stuff. But we started giving him a salary. So if you do these chores, we'll give you $6 a week. And if you save that money, we'll give you $7. So a little bit of extra bonus to kind of incentivize him. And after about 4 or 5 weeks, he's like, I am never going to get there. It's $100. What can I do? And I'm like, how about a lemonade stand? He went out there and sold like $38 worth of lemonade in an hour. I mean, it is the best like ROI I've ever seen a kid have. And like that kind of kicked it into motion. So I'm just wondering how other people teach their kids about money to help them see the light.
Yeah, I think what you did is great. That's for the most part. So he's really aware of what I'm doing for work, because he for 2 years, I lived in one of our deals, and is also the one that had our office in it. And so he would also come to the office. He knows the names of all the employees, like, cause he would pop in. So he's wide. He really knows what we're doing. And he also I don't know if anyone's ever listened to a sleep story, and this is about to be the worst endorsement ever for my own podcast, but here we go. So he used to listen to the Calm app for sleep stories, like, stories about a bear that they're reading slowly, and you fall asleep and takes your mind off your day or whatever struggles you have as a 5-year-old. And the sleep story he likes now is hearing my podcast. And so he doesn't, so I ask him, do you want to hear me as the host or the guest? And if he says guest, then I'll look up like one that I went on. And if it's a host, then I'll put on the Breneman blueprint. And the idea though, I think, is he just likes, he likes to hear me talking. It's like soothing maybe. And so he's learned a lot actually hearing these episodes. Cause the other day I asked him if he knew what I do, and he basically broke down, how like a 5-year-old would describe it. Yeah. What we do, how I got started. Like he knew I used to be he like the stuff I just said, he already is aware of this. He knows about the internet business and wheeling and dealing. And so now he's starting to think that's probably like normal behavior. So then, like I have $5, he's thinking, and then I explained you could invest that. And yeah, the first deal I gave a ridiculous return just to get his interest, where to make it simple, like your $5 will turn into 10 if you put it in for 2 weeks. So, and then my girlfriend was like, well, why don't you give me that deal? Like I got want to invest, 50 grand,
6-figure checks in the back.
Yeah,
if you
I know.
got any of those lying around.
Yeah. She asked if she could put 50,000 in that. And then I asked are you 5? Like just teasing her, but they were, but then the next one I did a lot lower return, where he put in his 10 and got 12 or something. Just try to make it interesting, where he never saw a $2 bill before. And I got a $2 bill back when I was getting changed for some reason. And so I don't know, he has a list of things to do each week, but it's not, he kind of loses track of it, to be honest. I think he's a little young for that, but he has a way where he could earn, I think, $4 a week. It's like each item's worth 10 cents, and the way it adds up, it's like, I think he can make maybe more. The most he's made is 4 in a week. I think probably if he did it all, he could make 10 or 12, but he's not, I think he's too young for that. But yeah, I like what you're talking about. And I guess it's interesting you worded it as a salary, because to us, it was like a reward for doing your weekly things. And then too, if you get, you don't get a smiley face at school, you get deducted 10 points, which would equate to $1. So if you're missing up at school.
that really spurred a whole different conversation around like, why is Jeff Bezos one of the richest people in the world, used to be the richest? And I talk about like the value people create in this world, and like the people that are the wealthiest tend to create the most value in this world. Think about it. Shep is what I say, is like you can get anything at any point delivered to your house within 24 hours. Isn't that just incredibly valuable? Now, maybe again to a 7-year-old, they're like, it's always been that way. But to us, I think that kind of emphasizes the point of how much value he's brought to this world.
Yeah, you're right. And I've ended up saying a similar thing because my son just loves Teslas, and so he knows who Elon Musk is, and asks a lot of questions about what they're doing. And yeah, I mean, like, he has a lot of money, and it's because look at like the impact he's had. So right. Yeah, it makes sense. So
right. So back to the real estate investing, your first deal was a retail shopping center, and then talk us through, I think you were working at a real estate company at the time is what you mentioned, then you kind of broke off. Talk to us about that transition. Do you think that working at a real estate company really helped you develop your chops to go into this space? Just talk us through that.
Yeah, I think out of the stuff I did early on, I think the most important piece, if I could give advice on that, was that I think the hardest way to quit your job, I think is, or even to find investors would be, let's say I would be working at a place and then I'm going to quit because I have this idea to invest. I have no deals, I'm pitching investors, and I quit my job. I got no money coming in. You really have a short runway of time doing that. And then, no personal track record. So what I did, and I didn't, this wasn't really like a grand plan, but looking back on it, it's what I would definitely recommend, is I was working what I would call like 3 jobs from 2008 to 2011. So I had my own properties that I had bought in Madison. I had bought 4, I had sold 2. So I still had 2 rentals there that I self-managed from out of state. By that point I had moved to Illinois, but and then I was working in Minnesota at a W-2, and then later in Chicago. And then I had the partnership with the father and the son, the business we called the Blackhawk Investment Group. And so I did all 3 of those at the same time, nights, weekends, during the day. I had no free time. I didn't do anything on the weekends, really. I would just wake up, go to my job. I'd come back thankfully, the second job I had, I could leave at 5, because then I could work from 5 till midnight on the other stuff and just repeat. But what I was able to do is when I quit my job in 2011, I had 2 deals on my own, and then 5 that I owned with this family, and pretty sizable deals, $20 million total. And then we had a $3 million shopping center on the way that we were also buying for a 6th deal. And the way we set up all those early deals, it was just the 3 of us, and the dad isn't like a private equity guy. So we originally looked at doing like a fees and a promote and then a preferred return, and or a preferred return with once you hit your preferred return and pay the capital back, and then you get a share of the profits. But we ended up, he thought that sounded like a lot of fees and it was complicated. So we ended up just settling on a straight up split. We just split 80-20 on every deal, and with the capital being returned upon sale. And so the idea was like, you do the work, and you put in the money, and then that's that. But there's no fees. So then that was, would have been hard to do if I had quit my job, let's say, and I needed like that acquisition fee or the guarantee of the asset management fee coming in. But I didn't need that. And then that's what this guy was most comfortable with. And, if you can do what your investor is most interested in, assuming it's like fair enough for you, like he would be more willing to keep participating if he liked the structure. And so I know most people and I think the incentives are, you can argue on incentives. Like some people would say like, that's surprising you're getting paid right away. But also then I wasn't getting a fee. So like you could say, right, with like a fee and a promote and a pref, like, are you incentivized to push deals getting a fee? Or on the flip side, the structure we had, are you incentivized to push a deal along because you get paid right away versus waiting until you make your 8 pref or whatever and pay the capital back? So I don't, so you could argue it both ways, but what fortunately happened was we ended up in a structure where no one was incentivized to push for a sale, because normally probably in a lot of these setups, the sponsors own the deal for 5 years, or they might not have been paid anything yet in terms of the share of the profits, because you have to pay the pref, which in this environment, the cash flow has been very low on many deals. So that if you have an 8 pref, let's say the deal probably has not been making an 8 So you have a accrued pref you got to pay back, then you got to return the capital, then you get something. So it pushes the sponsor to sell. And fortunately on these deals, we didn't have that setup. So we have deals, that first one we bought in 2009, I still own. And so we, and we have a lot of deals we've owned for more than 10 years. And so that's really helped us where we've built a lot of wealth. Doing it that way on that first deal, we've already 4x'd our money. So 4 times the investment. He put in $525,000. We've already distributed out over $2 million, and we still own the property just from that one deal.
Amazing.
So, which if I was incentivized with a preferred return and a pref, maybe I would have been pushing to sell that in 2013. Prices went up a lot between 2009 and 2013. Or whatever 5-year hold. 2014. We would have been thinking about selling.
So a couple of questions on that. One, have you rerun the numbers on those older deals to see, hey, if you would have structured this in a typical syndication, what those would have been?
Well, I haven't, but in a lot of the deals that we underwrite now, I do know what Breneman Capital's share of the overall distributions would be. So in like our waterfall today, I guess it depends how much money you put in, but the stock waterfall is 8% pref, then a 70-30. Then once you hit a 12, it's 50-50. And then depending if you invest more than $500,000, like we sometimes either don't do the 50-50 over 12 or change it to a 60-40. With that waterfall, we get roughly 20% of the overall distributions on deals that are, let's say, underwritten to a 15 IRR. So those deals we did way better than a 15 IRR. So far, our average IRR on stuff we sold is 24. And a lot of the deals we sold were our worst deals to like put the money into something better because we weren't really thinking about promoting returns or anything at that point. So I would have probably made more in total doing a regular preferred return in the waterfall we have today, but I would probably not have been distributed as much so far. But in total, when we sell, I would be getting more than like right now to a 15 IRR. I would get 20%, but some of these deals are 30, 40 IRR. So but again, I'd have to push to sell, which then we wouldn't be aligned on that. He doesn't want to sell any of these. So yeah, I would have probably been better off with the traditional if we're just going total dollars, but also there's like a timing element. And then would we have just on the flip side, would we have sold those deals in, let's say, 2014? So then it's like I got a bigger percentage than 20, but of a way smaller number because we owned it for 5 years versus owning it for 10 or 12 or whatever we're going to do, 20 years. So we refied 2 properties actually right before rates went up, 10-year fixed, 3% interest, where you look like a genius in retrospect. But on one of the properties, like the deal we agreed on is we're going to flip one to a 15-year amortization and pay it off. So we're doing stuff that isn't accretive to the IRR, but more just you got a partner who's almost 70 years old, want to do it's more conservative, wants to, pay off a building, so so we definitely wouldn't be doing that stuff if we had that set up. I'd say, I want to get paid. I want to get my promote.
Hey, fellow investors, before we dive into our next segment of the show, I wanted to take a quick moment to talk to you about a fantastic opportunity for you to invest with me. As you know, here at Ice Cream with Investors, I'm passionate about real estate investing and helping you navigate the exciting world of wealth creation through real estate. And that's why, for the first time, I'm thrilled to tell you about an opportunity for you to invest alongside of me. Over the past 3 years, I've been investing in multifamily, mobile home parks, car washes. I've even become the bank and lent out money to fellow real estate investors on a short-term basis. And now you can come join me. If you would like to jump on a call and learn more about this opportunity, head to icecreamwithinvestors.com/invest and find a time for us to connect. And now back to the show.
So
yeah, you've lived in both of these worlds, right? We were talking about beforehand how in syndications there are fees associated with the acquisition cost, but you also have a lot of overhead to go get those acquisitions done. But you've also lived in this other world where you don't have to worry about timing of sale and holding the property too long because it drags down your IRR and just different things like that. How do you, I guess, why did you make the jump to kind of the syndication world? And then how do you think about both of those factors right now as we enter into a world where, nobody's really hitting prefs, cash on cash is really strapped, and rising debt costs? Just talk us through that.
Well, it was really more of just changes that happened in my career. So in 2019, the son and this father's son, so the son's name was Brian, he passed away. So he was 2 years younger than me, and he just passed away in his sleep. Like I know it's just like a mystery what happened. But I was thinking we would just keep doing deals, the three of us, really forever. And so that's why like we weren't selling deals to build a track record or doing anything. We were just thinking we're just going to recycle this money that we have from our own deals and not be raising any outside capital. So then when he passed away, I made a pivot. But it wasn't a pivot to syndication yet. It was, I went through and thought who have I talked to that was maybe interested in working together, investing, but we weren't set up to take on outside money. Like we were just really set like as a private company, like investing this money that his dad threw into deals and then redeploying it. Like our strategy actually from 2013 to 2019 was we had a $3 million chunk of money. We'd buy 10 million of property with it. We'd raise the NOI. We would refi all the money out. Then we keep the property. Then we'd buy another 10. And we did that for 13 deals in a row, full cash out refis, over 100% on average, and in a 1.5 year average time span. So that was a really good run. I mean, it was helped by rates were in the 4s. In Chicago, the cap rates, the stabilized cap rate at the time was like 6. So you had really good positive leverage. You stabilize it to like a 7 cap and you can refi your money out. So yeah, the whole business was just finding deals where we could do that. And so I found another person, the similar deal where it was a father-in-law and son-in-law. This time, a guy I met actually showing apartments of mine. He was another leasing agent, but he was interested in investing in property. What he was talking about doing, you could tell you needed a lot of capital to do. It was renovating buildings all cash. And in Chicago, that's a couple $1 million at a minimum. And so, I just kind of, when this all happened in 2019, re-engaged with him. And then we bought a bunch of stuff quickly together from 2019 to 2021 and still now, where I bought about $100 million of property with the first guys in Minnesota, and then another $100 million with the father-in-law, son-in-law, 2019 to 2021. And I started thinking like, I really should still diversify this business. And then I had people that were, asking to invest in our deals, and I still wasn't set up to do that. So then in 2021, I was like, let's take on these investors that are asking to invest with us, set it up. So I signed up for Juniper Square. One of the guys, my only employee at that point, he pivoted to be more like asset manager, investor relations, and I hired 2 more acquisitions guys. And then we started also looking at the Sun Belt. So then we bought 5 deals in Phoenix in 2021 and 2022. And then started getting rolling in Texas. We haven't bought anything yet, but that was part of my move down here. So that's so hopefully that answered your question. But it was more sort of just overall strategy for the business, and then having people asking to invest, and you're turning them away. But I think once you have more than the most common thing is the fees that the sponsor charges and a preferred return and a promote. So I think just as we've increased the investor base, like that's, I think, a normal, most common structure. So I think we, I'm fine doing that. I do still kind of favor longer term holds. Like probably the shortest deal length we would ever do would be 5 years. I just think that's how you make money in real estate. It's not like a 1 or 2 year game. It's just a make money slow, build wealth kind of thing. And you think of like these people that did it I know people in Chicago where their dad bought like 100 duplexes in the Lincoln Park neighborhood, back when they were 10 to 50 grand. And now that's like a minimum million minimum probably each type of thing, So like, I don't know what his IRR is, and it probably would have been pretty great if he sold in the 80s, but instead he made, $50 million, not including cash flow, and just from these duplexes probably. So like, that sounds, so I'm trying to do it kind of, sort of like that as well. So, make money slow, not just be selling everything every year or two.
At that point, who cares what his IRR is? He's wealthy.
Yeah,
so.
I know. That's why, it's a joke. Like he doesn't know either what it is. So.
Right. I don't want to breeze over the point that you mentioned that one of your partners passed, and I think that can kind of shape the way you view partnerships and different things like that. I don't know how to ask the question, but how did that impact you personally, and then how did that impact you on the business side?
Yeah, well, it had a big impact on everything. I talked to him more than probably anybody. and then for him to pass away, that was just such a big shock. And I mean, it changed everything. And then two, I guess, I mean, for like just in terms of totally personal, not related, but I got a divorce in 2020 where we moved out at that, and then divorces take a while, done in 2021. So it was just kind of wild to think like by 2021, the two people I talked to pretty much like almost the most, like probably 90% of the conversations I was having in my life, I don't talk to either of those two people again. It's totally crazy in terms of like how fast and how much your life can change.
Yeah.
And so so that is like my biggest memory of the whole thing. That's why I had to mention the divorce, because it's like it ended up happening kind of with I have the 5-year-old with her. So then we're still communicating because we're co-parenting 50-50, but it's not, so that was just such a surprise. So just kind of how much your life can change fast. So I don't know what if I have like a business lesson from Brian passing away, but one thing I might have realized it after just kind of observing partnerships, I guess, where I do want to answer that, but it's more just a general thing now, having done this for almost 20 years. And I will say when most people form partnerships, a couple things that I see that they do that now that I've been doing this longer, I think people should reevaluate. Like a lot of times people will partner and they don't, the idea is it's like we're partners, we'll be partners for life, essentially. Like this is, and I think probably the better way to look at partnering is to just think it's for like a period of time, or it could be for a period of time. Let's say let's say we were at a partner and my role would be, I'm going to get the investors, and I know about like getting loans done. And then let's say, Matt, you have the deals. Like maybe what if we go into that, we should say like, but the plan is we're not going to do this for life. We're going to do some deals. We're going to try it out for a little bit. And then even if it goes well, maybe we just think it's like for like a 3-year run and we can reevaluate. Just kind of where nobody's thinking it's like for life, especially if you have something already set up, like you're already doing deals. So am I. Like maybe it makes sense to partner on some deals and not on all. And most people, when they partner, it's like, no, we're partnering on everything and it's for life. And I think it's okay to like look at it another way, especially when you're first starting out. Like one person might, not be pulling their weight, and then there was no mechanism to reevaluate. So I think that's something I've learned. And if it works out and it's like you reevaluate in the 3rd year and it's going fine, like I'm not saying you need to just cancel it and you have to only be partners for 3 years. Like it's fine to keep working together. But I think it's, one thing that I found interesting is just how people go into it thinking there's only one option. It needs to be for life together and probably just 50-50. And there's a lot of ways you could do it. And I think, like for now, if I were to partner with somebody, like if it made sense, it probably wouldn't, I don't know if it would be 50-50. I already have a company and I don't know if it would be for life. Maybe it would be to help us like get over the hump or to raise capital or to do something. And so I think that's, that's a thought. And then I also too, a lot of times I see people that are partnering and what one of the partners is bringing is just something you could hire out. To like a third party. So what was great with my partnership with Brian, and then in both the partnerships that I've done so far, is we had complementary skills. Like I had the deals, they had the money. They were also both working on post closing, helping run the deal. So we were doing different stuff. But let's say if someone's only role was like, hey, I'll manage the properties. I don't know. Maybe you could just hire that out, and you'd have the whole kit and caboodle, all the profits to yourself, or could partner with someone else doing something else. So that's something else that I've noticed. Too, where if you could just hire it, and these are all uncomfortable conversations to have, obviously, because you're talking about telling somebody like, you have to figure out a nice way to say like, I'm just going to hire that out, and you might be friends or something. So it's, those are some things that I've realized over the years. So I'm not sure if I worded the partnering for maybe not for life right, or got the idea across, but
yeah, I think the main thing is, one, you want to make sure that roles are clearly delineated, and then two, there's some sort of checkpoint mechanisms built into the way you all go about your business to check to make sure everybody feels okay. And I know for my fiance and I, we have a Sunday debrief, we call it. Every Sunday morning, We spend an hour kind of talking through the previous week, making sure that she feels heard, I feel heard, talking about schedules, all those sorts of things. And with my business partner, I mean, we do that on Mondays. So I think it's important to understand what is your role, what is the other person's role, and then you have these checkpoints that you're communicating effectively or clearly on where you both stand.
Yeah, no, that makes a lot of sense. It's interesting. Yeah, I'm sure you're finding success with doing it that way.
One of the things I found interesting about you, though, is this idea that you're living in Austin, you've done some deals in Phoenix, but also that you still operate kind of in the Midwest. And I don't have a lot of folks on the show that operate in Chicago, let's say, and I know you have a lot of experience in Chicago. Some of us from the outside view it as a very landlord-friendly, tenant-friendly state and landlord-unfriendly state. But I think any market, somebody is doing deals. And you have found a way to kind of crack that nut because of experience. And I wanted you to talk through a little bit about, how you view Chicago, why you're investing there, and just take it from there.
So I think Chicago, that has a lot of positives that are not talked about. And I think, just for one, let's say starting out in investing, there is a wide range of property types and values. Let's say now I look at Phoenix and Dallas and these places, and there's not a lot of like duplexes for sale there. So a lot of people to start, they got to partner up, and there's 10 people partnering up to buy a 100-unit deal, and you need to have 5 co-GPs on it to get the loan approved and everything because it's such a big deal. Whereas, in Chicago, you can just start on your own buying a duplex. So that's one thing that I liked about it. When I was first getting going, is there were deals that there were the size I could do. And then too, that's the Midwest is very stable. I was talking to somebody where they're asking what have I been doing differently with high interest rates and just everything that's going on. And I said I basically just went back to doing what I was doing the last 15 years. Like it was, I was going in Phoenix, we're going in Texas, but all those markets with how much growth they had and how aggressively people were bidding on things, the cap rates were all below the interest rates at the time. So then that pushed everyone into these debt fund loans that were floating rate, because in order to get your loan to size out to any respectable leverage point where then you could raise capital on the equity side, you had to take these loans on that were sized by your exit, basically your exit NOI, like what you could get it to in 3 years. And so that puts there's a lot of strain in those markets now. If like a lot of the deals that traded the last couple of years all were financed that way, where now when their interest rate caps expire, they'll be 8-9% interest, and the deals unlevered make somewhere in the 4s or 5s. So there's potentially a lot of pain on those deals, whether people can recap them or sell them for what they have into them. We'll see. But so I could see where there's going to be a lot of choppiness and, potential, at least some level of distress in the Sun Belt because of how all those deals were financed. But when I look at the Midwest, nobody did any floating rate debt. You didn't need to. You could just buy a 5.5 cap deal in Chicago and finance it at, 2 years ago at 3.5% interest, or before that 4%. Like you had positive leverage the whole time. You didn't need to take on a debt fund loan because you had a day one, 5 cap. You didn't need to do something to the NOI to get it to a 5 cap. So the market is just very stable, steady and strong. And that in Chicago, where it's it's the 3rd biggest city in the country. So even though it's not growing that fast, it's very diversified. McDonald's global headquarters is there. All these tech companies, Facebook and Google, have offices there. I know there's a lot of headlines because companies move out, but there's so many companies already there that then, the employment numbers still go up. And the city of Chicago itself, and the state, the population is not growing, but the nice suburbs in Chicago and the nice neighborhoods they are. There is a lot of stuff under construct. There's new buildings are under construction, and like the single family home market in the suburbs, especially, it's multiple offers on deals. Price is still going up like today in 2023. I talked to somebody this week actually who she moved back to Chicago from somewhere. I forgot where now, but she was buying a place and she moved in with her parents because she can't buy she's getting outbid. Like it's like you're talking to someone in the Sun Belt in 2021, and it's
Yep.
the north suburbs in Chicago. So I think in a time like now, that's where you want to be. We can get positive cash flow, positive leverage day one. You're still, CoStar had an article out at the end of August where Chicago is number one for rent growth in the country right now, and number one for least new supply. So yeah, so we have not bought anything in over a year now, but we do have a deal under contract in Chicago that we're raising money for. And what we liked about it is we're stabilizing it to a 7 cap, and it's a 2-year-old building, a $20 million deal roughly. It's a nice asset that, a couple of years ago would have traded for a much lower cap rate. This will be probably the lowest trade per unit in the neighborhood by a lot. So like the price makes sense for what's there, but we've experienced the last 2 years 5 to 9% rent growth on our buildings in Chicago back-to-back years, and I own 16 buildings in Chicago right now. And so when you understand the market and all the nuances, there still are good places to buy. Somebody that's really smart that told someone who works for me, if you could follow that, like that there's good deals in bad markets, there's good deals in good markets. It's just any way you slice it up, like, and that could be good economically, could be good, could be bad locations. Like there's people making money in real estate, probably in every city, and you just have to. And also one thing too is a lot of this stuff where, like, just numbers wise, yeah, Austin, Texas, that's the best city for population and job growth. It has GDP growth that's 2 standard deviations beyond the national average. It's been number one for population and job growth we calculated this all this data nationwide and picking new markets, and that's the most correlated with prices going up long term. So Austin's got a lot going for it, but right now it's got more new supply than any new market, basically tied with your hometown for the most where we're living at, and with Matt in Nashville there. But we have and so they have huge tailwinds, a lot of these cities, but guess what? A lot of that's priced in. It's not, there's no one stabilizing deals in Austin. It's a 7 cap. If you can get it to a 5 cap, you're lucky. But interest rates are in the 6s. So the deals are really hard to pencil. And, that'll make sense when the growth comes back, or if there's some discounts because of all the new supply, or people with floating rate debt just wanting to sell. But right now, like the Midwest makes sense to buy now. It's not going through like a reset with floating rate debt or too much new supply. It's just growing kind of slow and steady. A lot of markets are at cap rates where you have positive leverage. It's just traditional real estate investing.
Yeah, the CoStar report you referenced, I think the Chicago rent growth was 3%. And to everybody listening for the past 3 years, you'd be like, wow, that is super low. I don't want to invest in that because I'm used to seeing 22% growth. Well, 3% is historically average. And right now, when everybody else from Phoenix to Austin to even Nashville is experiencing -7, -2, 3% don't look bad.
Yeah, and what's interesting is it's really, to your point, where it's really just market by market, and also just parts of the city. Like in Phoenix on our deals, we have one deal where the rents are probably are down 7 or 8% in the last year, and another where they're up 7 or 8. So, and they're in different parts. There are one's in one suburb, one's in one part of Phoenix. Like it's just things also perform differently. Where within Chicago, we have no buildings that have done as little as 3%. I think that 3% for the market is probably for all of the suburbs, and when it's like the MSA, so it's pulling in parts of Wisconsin and Indiana too. But for the nice neighborhoods in Chicago, the real number is 5% plus the last 2 years. So like that's where too. So you can make deals in any market, and I think really for us, we're trying to minimize variables, focus on deals that we can execute on now, and don't have like a ton of moving pieces. So that's what I like about it, where it's like it's a risk off time, and this has high cash flow. It's a new building. We're coming in with a fixed rate loan, 7% cash on cash. Like there's very few ways where we're gonna get burned on this. Where there's lots of deals where people are taking them on. It's floating rate debt. They're going to acquire the property. It's in a tricky area. Then they're going to renovate it. Then they got to re-rent all the units. And there's so much more risk on that, and places that can go wrong. Then they got to execute a refinance. to get out of the bridge loan, and then it's a 3-year hold, so also the market's got to be good in 3 years, and there's a lot of moving pieces in those deals, and we've done those deals. It's just I think it's not the time for that right now. So that's why we pivoted, back more to just what we were doing.
So Drew, you built a fantastic portfolio, done a number of different things in a number of different markets for a long time. Where does this end? Where do you see yourself in the next 10, 15 years? Where's the North Star?
Yeah, I mean, I want to just having these offerings to passive investors, and I think we want to also start catering more to family offices and just like bigger individuals. So I think that's something that we're going to work on. But I've done a lot of I would say really good real estate deals, but I was always the point person for them doing them. Like I want to build a real business where it's not just the from all those deals I was talking about that we did in the past, like that I sourced all the deals, I closed them, like I did every step. Like I want to have a actual, develop a real business where, it's not, deals are coming in and like it's an actual company where I have, operating leverage as well. And we're providing a good product for our, not our tenants as well as our investors. So
gotcha.
Where does it end? Well, I don't know. I was surprised that I got $2 million of property in college, and I'm very surprised that I'm at 200 whatever million now. So wherever it ends, I'll be surprised that we did it. But at a certain point, you just you see like this $20 million deal come in, and you're like, yeah, this is a good one. We can do it, and you just do it. So
yeah. Well, I want to shift us now to our last round. We're calling this the 4 toppings. Our first one is, what is your favorite book, or what is a book you've read recently that's given you a paradigm shift?
Yeah, the Jim Collins Good to Great is my favorite business book. It's not necessarily about real estate, but they break down what, and this doesn't do it justice given it this description, so everybody check it out, but it's where they break down the difference between good companies and great companies. Like, why did one company grow at 3% a year? What were their tactics and strategies, and why did one grow 200% a year? And just that, I probably learned more from that book about business than any one book.
Yeah, I haven't read that book in probably a decade, so I need to go revisit that, actually. Our second one is, what is the best piece of advice you've ever received?
Well, I think I don't know if it's the best, but I think for timeliness, definitely that there's good deals in all markets. Where like that I have thought about more than any advice that probably in the last couple of years. Because you think even though the market, whether that's the city you're in or overall whatever product type you're investing in, it's a tough market, but there still will be deals out there. It's just it's not like shooting fish in a barrel when interest rates were 3 and everything was growing 10-20% a year. It's a lot tougher, but there still could be good deals out there. In retrospect, when I was doing those deals 2009 and 10, it was a junk market, or whatever. But it was, we found some good deals and it ended up working out great. And so I think you could wake up in 2-3 years, find yourself a similar spot where you'd be happy with whatever you bought too. Cause we're about to, at least in multifamily, we're going to have a total drop off in supply where no new projects are really getting started because they don't pencil with high interest rates and putting so much more equity in them. And so there's going to be almost no new supply in 2025, 2026. So we got to get to that point. But then by whatever you buy between now and then, you're probably going to look like a genius when the rents explode because there's no new supply and all these cities are still growing and we still don't have enough housing. So
yep. It goes back to, I believe, all real estate goes up and to the right. You just have to hold it long enough.
Yeah.
Our third one is, what are you most proud of in your life?
Yeah, I think that's a good question. I was thinking about that ahead of time, and I don't really have like a one thing that I would point to. I mean, I'm proud of just what I've been able to do just business wise. It's been I've surprised myself, and along the way, like obviously people reach out and they want to ask a question or get advice, and I always have sort of that's what I'm trying to get to is like I pride myself in being a nice person, where I'm proud of obviously my business success and all that, and obviously most people that have a kid would say being a parent, but I think really just trying to being a nice person where people will send me messages or questions about how does something work, and I just answer them. Like if you just, I mean, obviously if it's like 10 questions that take forever, like that's too much. But if someone has something or they want to talk, like I just talk like a regular person. Like there's not, like I don't act any different now or 20 years ago. I'm just a regular guy. So that's how I sort of pride myself on that, just not being too fancy or whatever. So either.
I like it. Well, our last one is, if you could sit down and eat a bowl of ice cream with anyone, dead or alive, who would it be and why?
I think Warren Buffett, that I went to the Berkshire Hathaway conference in 2015 or 16 and Warren and Bill Gates both walked right by with like in front of us. So that was like a cool experience. Just on the floor with like 20 security guards. And so I think that, and also I went to the Drake concert last week and Drake walked out in the section we were. So I'm getting this collection of videos on my phone of people walking out. But I think just the way he invests, it's kind of similar to my thought. Like he's not doing anything too crazy. It's long term, make money slow. But it can really work for you if you you don't go broke, for lack of a better term, along the way, or just pile it on. Where a lot of people, they like these businesses that grow, they get real big, then it's like they can't operate. Where I don't want to do that. Like I like the just kind of slow and steady type win the race sort of vibe.
Yeah, I actually am surprised. I don't think Warren has been mentioned on the show yet. He might.
I'm very surprised by that. When I saw you smile, I thought that's because that's like what everybody says. But he's not a real estate guy, I guess. But like, would he not be one of the most iconic investors where you'd want to know what, what would he do? So I mean, people go to Omaha for that conference. Thousands of people just to learn from them. You can be one-on-one. Why not?
Yep. Well, Drew, fantastic conversation. If our listeners wanted to reach out to you and learn more about you, where is the best place we can point them?
To Breneman.com. So that's Breneman Capital's website. We have a portfolio on there. You can sign up to be an investor. You can, we have a passive investing guidebook on there. You can download that and learn about passive investing, how it all works. We were talking about this waterfall stuff for a long time. That's all broken down in there. Different types of investments, how it all works. I have my own podcast, the Breneman Blueprint. That's a real estate investing and entrepreneurship podcast you can check out. That's on every podcast platform plus YouTube. So, and then I'm on social media at Drew Breneman, but I guess I'm not. I post a bit on there, but I'm not as regular with it as I should be. So
perfect. We will leave all those in the show notes. And then Drew, thanks for coming on the show.
All right, thanks, Matt. Appreciate it.
Thank you for listening to Ice Cream with Investors. If you like what we serve you here, it would mean the world to me if you would like, subscribe, and leave a review on your favorite podcast app.